Making money doesn't always mean that you have built a great portfolio. This investor made over 1.3 million Kenyan shillings, but after reviewing the portfolio, I still recommend making several changes. Let me show you what exactly we found on this portfolio. So this client came with one goal. I want a long-term capital growth and dividend growth from this portfolio. And then we settled with that. So if we look at this portfolio, we have a list of several companies. That is Equity Bank at 42%. We have Umeme at 35%, KCB at 8%, Absa Bank at 5%, I&M at 4%, Nairobi Securities Exchange at 3%, Kenyan at 2%, and we have Crown Paints at 1%. Not bad, but this portfolio still have weaknesses and strengths. So I'll be starting with strengths and then I finish with the weaknesses. So the first strength is excellent blue chip selection. We have KCB, Equity, Absa, I&M, Kenyan, and Nairobi Securities Exchange. They are excellent, business established. They are good. Second strength is strong capital appreciation. The portfolio has already provided with 1.3 million Kenyan shillings gains. Our third strength, dividend income potential. So we have a lot of companies here paying dividends. We have Equity, KCB, Absa, Kenyan, and the Nairobi Securities Exchange. They pay dividends. We have the fourth strength, which is multiple sectors. We have banking sector, utility sector, insurance sector, manufacturing sector, and we have finance services. Let's get into weaknesses. We have our first weakness, which is massive concentration risk. What do I mean by this? We have Equity at 42% and we have Umeme at 35%. Together, they create 77% of the entire portfolio, which is very risky. If those two sectors are affected, the entire portfolio collapses. Our second weakness, overexposure in banking sector. Since we have a lot of banks, we have Equity Bank, KCB, we have Absa, I&M. And if we include all the finance services, we have even the Nairobi Securities Exchange, which add up to 62% of the entire portfolio. So if the banking sector is affected, the entire portfolio is affected massively. We go to our third weakness, which is missing consumer stocks. What do I mean by this? These are sectors like consumer goods, telecommunication, healthcare, we have agricultural and real estate. Our fourth weakness is utility concentration. So Umeme alone has been represented by 35%, which is extremely a lot. Utility company like Umeme. So we'll review company by company, and since we want to eliminate some companies and add others to establish a stable and strong portfolio. So we will start by first company, which is Equity Bank. I will give it a 5-star and I will keep it in the portfolio since it has shown excellent management, regional expansion. We have strong earnings, growing loan books, reducing non-performance loans. So it's an excellent one. The only weakness, it's 42% of the entire portfolio. This is too much. I would reduce it to avoid overexposure. The second company is Umeme. So for Umeme, I would entirely remove it from this list. And here is the reason why I would remove it completely from this portfolio. It has an expired 20 years electricity distribution in Uganda. And currently, it has only been depending on compensation, negotiations, attributions, and legal processes rather than operating in growth. So that seems not to be a good option for the client's goals. So let's go to the other company, which is KCB. KCB, it's a good company, strong dividends, good growth, and reasonable valuation. So I will keep it. So we go to the next company, which is Absa Bank. I will keep it. Literally, that is, it has shown strong profitability, good stability in the market, and literally it has created the confidence that even banks from outside or companies from outside, they are willing to invest in it. So we have like Absa Group Limited from South Africa, which is currently investing heavily in Absa Bank, which shows it is showing the confidence in other sectors, in other companies to invest in it. So we have our next company, which is I&M. I will totally eliminate it. It is a good bank and it has growing steadily, but the reason why I would eliminate is it to reduce the exposure of the banking sector. And since I have chosen the three most strongest, that's why I would eliminate I&M Bank. So let's go to the other sector, which is the Nairobi Securities Exchange. For this one, I would say it's either a keep or sell. It's a good sector. It is showing steady growth. And basically, if you look on how it makes money, it's through the high volumes of trading, or when a new business or company is being listed in the Nairobi Security Exchange. That's how it creates money, of which it is growing, and it will still be growing, but it is a slow growing sector. So if I would tell a client, if you still need safety, it's a good consideration to go with it. And if you need somewhere you can generate more income, I wouldn't advise they should choose it, but it is a good sector. So that's something to consider as well. So we have the next one, which is Kenyan. Kenyan, it gives an exposure to the insurance sector, and it improves diversification, which is it has reliable dividends. And what I would recommend for it, it's keep it. It's a good company. We have the next one, which is Crown Paints. For this one, I would entirely eliminate it. The reason, it only occupies 1% of the entire portfolio, and 1%, even if it doubles, it won't do anything to your portfolio, even if it doubles. So literally, it's very small. It's either you increase it or you eliminate it. But for now, I would entirely remove it. So here is the companies I would highly I will be adding on this portfolio so that we balance it well. So if we look the companies that we have eliminated Umeme, we have eliminated I&M, we have eliminated Crown Paints. So those are three companies. The two companies I'll be adding Safaricom, because if we are looking over long-term growth, and looking at the amount of investment, which is 10 million as per now, and since we are looking for a long term without something like Safaricom, we might be missing a lot. So we will be adding Safaricom. Reason being, it gives telecommunication exposure, it gives mobile money ecosystem, it gives dividend potential, and also a different earning drives apart from the banks, because it doesn't earn the same way as banks. So it creates a strong consideration to add it in the portfolio. The other company we will be adding is EABL, Eastern Africa Breweries. What usually is very important, it's always aligning your portfolio with what you need. You have to identify your goals. Is your goals taking this portfolio for the next 10 years? Are you trying to build generational wealth? Are you there for 1 to 3 years and then you get out? Because each period requires different sectors that should make you earn